you so much.
Let's bring in our market panel right now. We have Lee Munson. He's the founder and chief investment officer of Portfolio LLC. And Michael Binger is the senior portfolio manager with Gradient Investments. Gentlemen, good to see you. Lee, first to you. A lot of folks out there are waiting for a big pullback. I mean, today we had almost triple-digit down. I think the Dow ended down about 99 points. But we haven't seen any sort of big pullback. You say don't wait for the big pullback. It might not be coming. Why?
Well, let's talk about what the big pullback is first, Dave, because there's a difference between selling on the news of a fiscal cliff deal versus the Armageddon if we go over the fiscal cliff. I think that right now, if you've been in cash because you got bamboozled by politicians thinking that we're going to go off the edge and the market's going to go down 50%, I think you got bamboozled. I think you have to start putting money back in. Now, I think if you're more tactical, you want to see when we get this fiscal cliff done, I think that there will be some selling of the news, and I think that that's going to be another way that you can get in. But I'm certainly not thinking that we're going to get a 20, 30, 40% correction like some have seen. Plus, 2013 is going to be great. Now, I'm not sure about double-digit earnings growth, which I'd love to see, by the way, but we've got, credit easing in Europe and UK and a miracle in Japan. I mean, it's incredible. Earnings are starting to rebound because nominal GDP is increasing. And then the other thing about volatility is going lower, and that makes what could happen more tight, and so there's less variability going in next year. All those three things, I think we're going to have a great year as far as price performance is concerned.
Michael, you're optimistic as well, but we know this, and we just showed the S&P for the year up about 16% year over year. The NASDAQ up 17%. These are beautiful performances. Can they continue through 2013?
Well, I get to ask that question a lot. When people say, oh, the markets are up, they're expensive, that's not necessarily so. You need to examine why the markets are up. And the markets are up because the consumer is confident in spending and earnings are great. And the stock market is made up of individual stocks that represent corporate earnings. So as I look out into 2013, I see a bunch of tailwinds. I call the energy sector. The housing sector is getting a lot better. I do agree that capital equipment, capital spending, and manufacturing is making a renaissance in the U.S. again.
Okay.
And I believe that all those tailwinds combined with the cheap market make for good earnings, which will make for a good stock market next year.
Michael, let me be specific about one point you made, because I brought it up with our trader from the CME. Most companies right now seem to be underinvested when it comes to capital equipment. 2013 might be the year that they begin to spend that money on their capital investments. If that happens, could that not create a boom, at least in the sector of capital equipment?
I believe you're absolutely correct. I think corporate America has very high margins right now, but those margins have come because of cost cutting. And I think that cost cutting profit trend is kind of wrung out right now. To grow in the future, I think they're going to have to invest, and I think they're going to have to invest in people. So I see employment getting gradually better. I think they're going to have to invest in technology and capital goods. And I think that creates a boom in the U.S. economy, along with energy, along with housing. That's where I see things going in 13.
Lee, make us some money here. What are you investing in then with the perspective you've just articulated?
Well, first of all, I want to say that, I agree with a lot of what Michael's saying, but, I'm taking a little bit different approach. The market is churning right now. It's going from sector to sector, and I find it very hard with the growing monetary base and all the things that Michael's talked about, which I agree with, that there's going to be particular standout sectors that we can invest in now and that we're going to profit from 6 to 12 months from now. I would much rather see people, if they want to, get shown the business of this market and make some cash, I'd look at small cap and a broad-based index. Don't worry about value. Don't worry about growth. Don't worry about housing. I think it's going to be great. Don't worry about capital equipment. Still think it's going to be great. But just get that whole index and get the rise of that market in the highest beta sector. I think if you want to go outside the United States, go for those emerging markets. You don't have to go necessarily into Europe right now. But I would say keep it broad, because if not, you may end up getting that one sector that just didn't really bring home the bacon. So keep it broad. Keep it cheap. I think you'll make money no matter what.
Well, Michael, if you do like the technology sector, you have a broad way of approaching that with the ETF XLK. That's one way of putting your money, betting on an entire sector rather than just one stock.
Yes, I would agree. I think the XLK is a great way to play technology investing that's going to take place in corporate America and, frankly, around the world, especially in emerging markets. The XLK is a broad base of U.S.-based technology stocks, which I think are cheap right now. It's dominated. The biggest holding in that ETF is Apple. I think Apple's pulled back. I think the ETF, it's at an optimal point to buy right now. I think that ETF will make you money in 2013.
Michael Binger and Lee Munson, always a pleasure to see you guys. Thanks very much for coming in. Appreciate it.
Thank you.